Welcome to Dave's Daily Crypto Take. Today is Monday, February 7th, 2022. Let's take a look at today's charts. At number one, BTC is at $41,763.11, up 0.46%. Ethereum at number two, $3,004.12, down 0.82%. Tether at number three, $1. BNB number four, $415.44, down 0.74%. USD coin, 99 cents. Cardano at number six, $1.14, up 0.57%. Solana at number seven, $113.32, down 1.32%. XRP at number eight, 67 cents, up 1.21%. Terra at number nine, $54.52, down 3.25%. And last but not least, number 10, Polkadot at $21.49, down 0.68%. Take a look at the crypto fear and greed index. Extreme fear can be a sign that investors are too worried. That could be a buying opportunity. And when investors are getting too greedy, that means the market is due for a correction. So what we got today is fear at 45. Yesterday was fear at 37. Last week was extreme fear at 20. And last month was extreme fear at 10. Let's take a look at our 5 articles today. Article number 1 is crypto rug pulls. What is a rug pull in crypto and 6 ways to spot it? Article 2, North Korea missile program funded through stolen crypto, UN report says. Article number 3, Cardano assessing the odds of a reversal ahead. Article 4, SEC versus Ripple, lawyer representing 64K XRP holders tries to predict SEC's next move. And last but not least, today's main topic is the Bitcoin family immigrates to Portugal for its 0% tax on cryptocurrencies. All right, before we get into the articles, just want to say thank you so much to all my supporters. I've been looking at the analytics and I see a lot of people listening in from the States, from Spain, and from the UK. So shout out to all you guys. If you guys can, please share my channel, Dave's Daily Crypto Take, on Apple, Spotify, and Google Podcasts. And if you're in the YouTube space, like, share, and subscribe. All right, let's get into it. Article number 1 is crypto rug pulls. What is a rug pull in crypto and 6 ways to spot it? So number 1, what is a rug pull in cryptocurrency? A rug pull is a type of crypto scam that occurs when a team pumps their project's token before disappearing with the funds, leaving their investors with a valueless asset. Rug pulls happen when fraudulent developers create a new crypto token, pump up the price, and then pull as much value out of them as possible before abandoning them as their price drops to zero. Rug pulls are a type of exit scam and a decentralized finance exploit. Before learning how to spot a rug pull in crypto and why crypto rug pulls happen, it helps to understand the 3 different types of rug pulls. So what are the various types? There are 3 main types. So number 1 is liquidity stealing, limiting sell orders, and dumping. So liquidity stealing occurs when token creators withdraw all the coins from the liquidity pool. Doing so removes all the value injected into the currency by investors, driving its price down to zero. These liquidity pulls usually happen in DeFi environments. A DeFi rug pull is the most common exit scam. Limiting sell orders is a subtle way for a malicious developer to defraud investors. In this situation, the developer codes the tokens so that they're the only party that is able to sell them. Developers then wait for the retail investors to buy into their new crypto using paired currencies. Paired currencies are 2 currencies that have been paired for trading, with one against the other. Once there is enough positive price action, they dump their positions and leave a worthless token in their wake. And the squid token scam exemplifies rug pulls of this kind. Dumping occurs when developers quickly sell off their own large supply of tokens. Doing so drives down the price of the coin and leaves remaining investors holding worthless tokens. Dumping usually occurs after heavy promotion on social media platforms. The resulting spike and sell-off are known as pump and dump scheme. Dumping is more of an ethical gray area than other DeFi rug pull scams. In general, it's not unethical for crypto developers to buy and sell their own currency. Dumping, when it comes to DeFi cryptocurrency rug pulls, is a question of how much and how quickly a coin is sold. Next, hard pulls versus soft pulls. Rug pulls come in 2 forms, hard and soft. Malicious code and liquidity stealing are hard pulls, whereas soft pulls refer to dumping an asset. Rug pulls can be hard or soft. Hard rug pulls occur when project developers code malicious backdoors into their token. Malicious backdoors are hidden exploits that have been coded into the project smart contract by the developers. The intent to commit fraud is clear from the get-go. Liquidity ceiling is also considered a hard pull. Soft rug pulls refer to token developers dumping their crypto assets quickly. Doing so leaves a severely devalued token in the hands of the remaining crypto investors. While dumping is unethical, it may not be a criminal act in the same way that hard pulls are. Next, are crypto rug pulls illegal? Crypto rug pulls are not always illegal, but they are always unethical. Hard rug pulls are illegal. Soft rug pulls are unethical, but not always illegal. For example, if a crypto project promises to donate funds but chooses to keep the money instead, that's unethical, but not illegal. Either way, like most fraudulent activities in the crypto industry, both types can be challenging to track and prosecute. The collapse of the Turkish cryptocurrency exchange, Thodex, is a prime example of a rug pull in crypto. The $2 billion theft was one of the biggest crypto rug pulls of 2021. It is also one of the largest centralized finance exit scams in history. Although Turkish police detained 62 people during its investigation of the major scam, the whereabouts of the alleged perpetrator remains unknown. Other recent examples of protocols that have suffered this type of crypto rug pull include Meerkat Finance, Olympus DAO, Compounder Finance, and Uranium Finance. So, how to avoid a rug pull in crypto? There are several clear signs that investors can watch out for to protect themselves from rug pulls, such as the liquidity not being locked and no external audit having been conducted. The following are 6 signs users should watch out for to protect their assets from crypto rug pulls. Unknown or anonymous developers. Investors should consider the credibility of the people behind new crypto projects. Are the developers and promoters known in the crypto community? What is their track record? If the development team has been doxxed but isn't well known, do they still appear legitimate and able to deliver on their promises? Investors should be skeptical of new and easily faked social media accounts and profiles. The quality of the project's white paper, website, and other media should offer clues about the project's overall legitimacy. Anonymous project developers could be a red flag. While it's true that the world's original and largest cryptocurrency was developed by Satoshi Nakamoto, who remains anonymous to this day, times are changing. So, no liquidity locked. One of the easiest ways to distinguish a scam coin from a legitimate cryptocurrency is to check if the currency is liquidity locked. With no liquidity lock on the token supply in place, nothing stops the project creators from running off with the entirety of the liquidity. Liquidity is secured through time-locked smart contracts, ideally lasting 3 to 5 years from the token's initial offering. While developers can custom script their own time locks, third-party lockers can provide greater peace of mind. Investors should also check the percentage of the liquidity pool that has been locked. A lock is only helpful in proportion to the amount of the liquidity pool it secures. Known as total value locked, this figure should be between 80 to 100%. Limits on sell orders. A bad actor can code a token to restrict the selling ability to certain investors and not others. These selling restrictions are hallmark signs of a scam project. Since selling restrictions are buried in code, it can be difficult to identify whether there is fraudulent activity. One of the ways to test this is to purchase a tiny amount of the new coin and then immediately attempt to sell it. If there are problems offloading what was just purchased, the project is likely to be a scam. Skyrocketing price movement with limited token holders. Sudden massive swings in price for a new coin should be viewed with caution. This unfortunately rings true if the token has no liquidity locked. Substantial price spikes in new DeFi coins are often signs of the pump before the dump. Investors skeptical about a coin's price movement can use a block explorer to check the number of coin holders. A small number of holders makes the token susceptible to price manipulation. Signs of a small group of token holders could also mean that a few whales can dump their positions and do severe and immediate damage to the coin's value. Suspiciously high yields. If something sounds too good to be true, it probably is. If the yields for a new coin seem suspiciously high, but doesn't turn out to be a rug pull, it's likely a Ponzi scheme. When tokens offer an annual percentage yield in the triple digits, although not necessarily indicative of a scam, these high returns usually translate to equally high risk. And no external audit. It is now a standard practice for new cryptocurrencies to undergo a formal code audit process conducted by a reputable third party. One notorious example is Tether, a centralized stablecoin whose team had failed to disclose that it had held non-fiat backed assets. An audit is especially applicable for decentralized currencies where default auditing for DeFi projects is a must. However, potential investors shouldn't simply take a development team's word that an audit has taken place. The audit should be verifiable by a third party and show that nothing malicious was found in the code. So, spotting a crypto rug pull scam, it takes some digging. In 2021, an estimated $7.7 billion was stolen from investors in rug pull cryptocurrency scams. These investors trusted that they were investing in legitimate projects, only to have the rug pull from beneath their feet. Before investing, it's worth taking the time to research new cryptos and to do one's due diligence before investing in a new project. So there you guys have it. What do you think about this article? Right here, it says crypto rug pulls. What is a rug pull in crypto and 6 ways to spot it? Comment down below and let me know what you guys think. All right, article number 2. North Korea missile program funded through stolen crypto, UN report says. North Korean cyber attacks have stolen millions of dollars worth of cryptocurrency to fund the country's missile programs, a UN report briefed to media yesterday. Between 2020 and mid-2021, cyber attackers stole more than $50 million of digital assets, investigators found. Such attacks are an important revenue source for Pyongyang's nuclear and ballistic missile program, they said. The findings were reportedly handed to the UN Sanctions Committee on Friday. The cyber attacks targeted at least 3 cryptocurrency exchanges in North America, Europe, and Asia. The report also referenced a study published last month by the security firm Chain Analysis that suggested North Korean cyber attacks could have netted as much as $400 million worth of digital assets last year. And in 2019, the UN reported that North Korea had accumulated an estimated $2 billion for its weapons of mass destruction programs by using sophisticated cyber attacks. North Korea has been banned by the UN Security Council from carrying out nuclear tests and launching ballistic missiles. However, the UN report says that despite crippling sanctions, North Korea has been able to continue developing its nuclear and ballistic missile infrastructure. It has also continued to seek material technology and know-how overseas, including through cyber means and joint scientific research. The sanctions monitor said that there had been a marked acceleration of missile testing by Pyongyang. The US said on Friday that North Korea, formerly known as the Democratic People's Republic of Korea, carried out 9 missile tests last month alone. DPRK demonstrated increased capabilities for rapid deployment, wide mobility, including at sea, and improved resilience of its missile forces. The sanctions monitor said on Friday, China and Russia refused to sign on to a statement condemning the proliferation of North Korea's missile launches. On Sunday, the US announced that its special representative for North Korea would meet with Japanese and South Korean officials later this week to discuss the situation. The UN report also found that the humanitarian situation in North Korea was continuing to worsen. It said that it was likely to be the result of the country's decision to close its borders during its pandemic. A lack of information from North Korea meant it was hard to determine how much suffering was being caused by international sanctions, it said. So there you guys have it. What do you think about this article? North Korea missile program funded through stolen crypto, UN report says. Comment down below and let me know what you guys think. All right, moving on to Article 3, Cardano, assessing the odds of a reversal ahead. So since earning its lifetime milestone of September 2nd, Cardano has been on a steep descent that practically moved it below all its EMA ribbons. Over the last 19 days, ADA has formed a bearish flag on its daily chart, while the 20 EMA stood sturdy. From here on, slightly weak readings on its technical indicators coupled with a bearish flag pattern have positioned ADA for a possible retest of the lower trend line of the flag in the days to come. At press time, ADA was trading at $1.13, down by 3.38% over the last 24 hours. Since its all-time high, ADA has formed a 5-month-long falling wedge, while the alt was on a sharp downtrend. Further, it lost over 44% of its value in just 3 days as it plunged to its 9-month low on January 22nd. Consequently, it formed a bearish flag pole while flipping the vital $1.2 mark from support to resistance. It becomes crucial to note that the $12 level support has stood at a testing floor for over 11 months. As a result, for the past 2 weeks, the bulls have been exerting pressure to reclaim the $20 mark, and they still struggle to topple the 20 EMA. Now that the $12 mark becomes a crucial critical point for the buyers to step in to prevent a further pullback, but any close below its immediate support would propel a test of a $1 mark support before a possible reversal from the falling wedge pattern. Should the bears dwindle, the bulls could initiate an attempt to recover the $20 mark, but that would most likely be short-lived until the bulls ramp up trend-altering volumes. So the rationale, although the RSI has been on an uptrend, it still needs to overturn its midline on the daily chart to affirm a bullish edge. Now, one must closely watch out for a break outside the existing flat range to ensure a prudent trading call short. The CMF steeply plunged below the zero line, depicting a bearish bias in the near term. Nevertheless, the alt revealed readings on its ADX at the time of writing. Conclusion, although the indicators are flashing mixed signs, the bulls still lack volumes to counter the broader downtrend. Thus, a possible retest of the $1 or 80-cent mark before a strong reversal should not be of surprise. Even so, traders, investors should keep a close eye on Bitcoin's movement as ADA shares a 76% 30-day correlation with the King coin. Further, they should also watch out for the on-chain metrics affecting the current and potential perception of ADA's value. So there you guys have it. Cardano assessing the odds of a reversal ahead. Comment down below and let me know what you guys think. All right. Before we get into round 2 of the articles, just want to say thank you so much to everyone that's been messaging and DMing me. Thank you for all your suggestions and recommendations for all the podcasts and videos in the upcoming months. Again, this is Dave's Daily Crypto Take. Please share it with your friends that want unbiased news or cryptocurrency updates. Again, there will be pro and cons about cryptocurrency, but please do your due diligence and do your own research. All right.